Hey, what's up, everybody? Welcome back to Investing Sucks. And in this video, we're finally going to do it. I'm finally going to reveal to you guys my entire personal portfolio. Now, this is something that I've been getting asked about pretty much ever since I started doing YouTube. And for a long time, I've held back on this because, for one, I didn't want people to just see what companies that I was investing in or see what ETFs I was investing in and just straight up copy it, right? Because if things ended up going sour with a particular investment, then I felt that people might come back and blame me for it. And to be honest, it just really didn't seem like a risk that was worth taking for me. But then, I had a change of mind. I kind of just stopped and thought about, okay, who are the types of people that are actually watching my content, right? Because all my content is longer form videos. They tend to be very, we go very in depth on a lot of different topics that aren't really the types of thing that, casual investors would be interested in. So the people watching my stuff is probably people that are taking their investing much more seriously, and they're not going to be, impressionable people who can't think for themselves. And I can tell based on the comments that I get from you guys that a lot of you guys are very smart, critical thinkers. And if I were to ever come on my channel and say something that was clearly wrong, or if I was misinformed about something, then I'd probably get corrected for it in the comments, or someone would send me an email afterwards. And I can tell from some emails that I get from you guys that are very in depth and, very well thought out emails, which I always appreciate getting those. So really, there isn't much of a risk, right? Because I don't think anyone is just going to see a company I invested in and then just drop everything and go buy that company just because I bought it, right? So that was one reason. And then also, to be honest, I was pretty concerned that revealing my personal portfolio would end up influencing my own personal investing. And I don't mean that in the sense where I would just be making videos about specific companies because I thought those companies would get me more views on YouTube. Because really, if you think about it, that argument doesn't make any sense. Because the amount of money that I would make from just investing wisely versus how much money I currently make from my YouTube channel, like, it just pales in comparison. So that argument doesn't really make any sense. I kind of meant it more in the sense that if I were to come on YouTube and make these public declarations about my opinion about a certain company, I might start to feel tied to those, right? Just because I've come on here and I've said it to so many people and I've been very convinced myself that I was right about something. If I start to see information that maybe would suggest that I'm wrong about something, if I have made a YouTube video talking about something and sounded very convinced, it might hinder my ability to change my mind, right? Which could lead to disastrous results in the future. So that was something else I was a little concerned about. And even though my videos don't garner massive attention on the internet, I just thought that there was no way that, doing that and releasing all my opinions online wouldn't affect my investing somehow or some way, right? But despite all of that, I have finally decided to share my full portfolio with you guys. And to be honest, it's nothing special, right? I've had it on screen here for a few minutes now, so you've probably seen the various holdings that I have in the various categories here. It's actually pretty boring, right? There's nothing crazy going on. There's no international stocks or options or, all these 20 different like companies that I have. It's pretty simple overall. And to be honest, I really like it that way. All right. I always appreciate simplicity in anything. I think there's just so many things that can be overcomplicated very easily. And when it comes to managing your finances, it really doesn't need to be that complicated. You can get by with a very, very simple strategy, just for the average person. You don't need to have all these different complicated things going on to be, financially successful in the long term. Now, obviously, everything that I show you is going to be represented in percentages of my portfolio. I'm not going to reveal the dollar amounts because that would just be dumb. Revealing your net worth publicly online is just not a good idea, no matter how big or how small it is. It just doesn't really make sense. But also consider, you guys, like, currently I'm only 25 years old, right? I've only been out of school for a few years now, working full time. If you think that I'm some super successful multimillionaire investor, that's just not the case, right? And I hope that's not why you watch my stuff. But that being said, I did do a few things early on in life, which I would say helped me get ahead. And one of those was being able to put myself through university without taking on any student debt, right? So not having to deal with student debt and pay that off as I progress throughout my 20s and in my life, which can really, hold yourself back financially. And there are a few things that I did to make sure that I could get through school without having to take on any debt. one of which was going to a school that was actually worth it. So I went to a school called Wilfrid Laurier University, which is a pretty prominent business school here in Canada. And it was a school that was very affordable, right? Living in, near my school, and the rent and the food and everything there was, it wasn't super expensive. It wasn't like I had to go to New York City and pay like 2,000 a month for a, terrible apartment just to be able to attend school. It was very affordable, and I was able to get internships, when I wasn't in school. So I was able to work, earn a decent amount of money, and then be able to put myself through school kind of as I progressed. And then also I would work part-time at my school during school, just doing, basic jobs. Like I had this job where I would teach people how to use certain accounting software that I had learned because I had done past internships in accounting. So earning money during school really helps you, get through school without having to take on debt, because, you don't just see your bank balance just dropping as you progress through school. And by the way, the reason I'm talking about this is because I know that some of you guys that watch me are currently in university. I can tell from the demographics on my channel and then some of the emails I get from you guys that a lot of you guys that watch me are, 19, 20, 21 years old, probably in school right now studying business or finance, just like I was, not too long ago. So I think, just a few pointers on that is going to be helpful to a lot of you. But anyways, we're a few minutes into the video. Let's actually start talking about the portfolio itself. So what you came here for. And I've had this on screen so you guys can probably, look at everything here. But one thing that may surprise you guys is the individual stocks part, right? So I only have about 11% of my portfolio in individual stocks. Now, that may surprise some of you guys, given that really my channel is about investing in individual stocks, right? That's pretty much all I talk about. I do touch on some economic things here and there, but that's the big chunk of um, what I talk about on this channel. And then in terms of this portfolio, it doesn't really represent that large of amount. And now the reason it's like this is because I have to recognize for myself that I have limitations, right? And I put limitations on myself. So I don't allow myself to hold more than really five, six, seven individual stock positions, because whenever I make another additional investment into a new company, my time investment into maintaining my portfolio goes up a lot, because now I have to understand everything that's going on with that company, keep up to date with their earnings calls, with their competitors' earnings calls, everything that's going on in the industry, if I want to actually make an informed investment decision and be successful with that investment. I have to do a lot of work keeping up to date with the company. And I do it because I enjoy it, right? Like, we call it work, but there's a reason why I make these videos and why I like to invest my own money, because I really enjoy this stuff, right? I love learning about different businesses and what makes a business successful. And that's why I'm here on YouTube talking to you guys. But even myself with that, I have my own limitations, right? Like, I work a full-time job, right? I have social relationships that I would like to maintain, right? I can't just sit in my room all the time and dedicate every waking hour to just reading annual reports and researching stocks, coming up with the best investment ideas. Um, and even though, I talk about this stuff on YouTube a lot, I just don't have the time to be able to be, like a full-time investor, and I can't really pretend like I'm a full-time investor either. So there is risk for me investing in individual companies, which is why I am going to really keep a cap in terms of individual stock positions in my portfolio to probably a maximum of 20-25%. Currently, it's at about 11%. And like I said, just because I have limitations, right? So that's one thing that, and I've also included my cost base on all my positions here. So all these positions, by the way, I have made videos in the past discussing these. So we can see EQB, Equitable Bank. This is my largest individual one, just under 2% of my portfolio. Thrive Holdings is another one. I made a video on this a few months ago. There is Malibu Boats, and then there is Markel, which is an insurance company. So I'll leave a link in the description to this video of all the videos I made previously talking about these four companies and what my thesis is, why I invested in them, things like that. So if I'm not going to take the time to go through each of these one by one here. So if you want to understand why I bought all these companies, then just check out those videos. And then I also have some company stocks. So like I said, I do have a full-time job, and with the company I work for, there's a stock ownership program. So I own shares in that company through that. And then I also have a small Wealth Simple account, which is just tracker shares, right? So these are just shares of companies that I've bought because I want to kind of force myself to pay attention to it. So I'll just buy one share of one company so that, it forces myself to keep up to date with that company. I'm not, that portfolio isn't, optimized for performance or anything like that. So that's a quick note on individual stocks, why I own what I own, and really what my plan is going forward, right? So probably not going to have this take up too much of my portfolio. Now we'll move to the ETFs here. So really, my ETFs, the one I own predominantly is probably 99% is XEQT. A lot of you guys probably own this one, and I'll just pull up, what is included in XEQT on screen here. In my opinion, it's the best all-in-one ETF for Canadians, and the key is international diversification. I am a big believer in international diversification. I think it is very, very important for a long-term investing strategy. And so there's another YouTuber, like another Canadian finance YouTuber by the name of Ben Felix. A lot of you guys have probably heard of him. And he has a great video on international diversification where he essentially points out that a lot of people, a lot of investors tend to only want to invest in US stocks because of the strong historical results, right? And really, it's been over 100 years where US stocks have beaten international stocks. And that can be very enticing to a lot of people. What you have to understand, in reality, it's not possible to predict what the best performing countries will be just purely based off of historical returns. So there's no guarantee that those historical returns will continue into the future, right? It's that age-old saying, don't make future financial decisions based on past performance. And really, a big reason for the United States doing so well over the past 100 years, if you think about it kind of on a broad sense, has been because nothing bad has really happened there, right? I mean, sure, there's been a few market crashes and some bad things have happened there, but really, there's never been something massive, something that can destroy a company financially, like a huge civil war or, runaway hyperinflation or a huge market bubble, like what happened in Japan in the 1980s, for example. The US has been very, very resilient. And then also because over time, investors have learned that US stocks are safer, and that has led to more funds being allocated towards US stocks, which has driven up their valuations. And generally speaking, higher valuations now means lower expected returns going forward. But that's a general relationship, right? It's not E equals MC squared. It's a general relationship, which is high valuations means lower expected returns. And if we were to look at this here, which is the Shiller PE ratio, so this is a pretty common metric that a lot of people will use to just understand the current valuation level of S&P 500 stocks, so US stocks. And we can see in the last decade, stocks have gotten progressively more and more expensive. It's kind of this part here, and it's fluctuated a lot throughout history, but historically, US stocks are quite expensive at the moment. So what that can mean going forward is potentially lower expected returns. But again, I don't know that for sure. And because I don't know that, the key is to just, be very internationally diversified and own a lot of different regions or really the whole world in general. And again, thinking about this from a broad sense, it really makes you think, can the US dominance continue and how long will it continue for? And it does seem odd to say that the US will remain the dominant superpower throughout the rest of all our lifetimes, even though pretty much throughout all of the lifetimes of everyone who's watching this video, the US has been the military superpower, and no other country was close, which in turn has led to, financial prosperity, etc. But eventually all empires fall. And because you just can't predict what's going to happen in the future, I think international diversification is a great way to get the best of both worlds. So I am a strong believer in it. But even so, if we look at the actual underlying holdings, this one here is the S&P 500. So this is what XEQT is made up of. So there's this other ETF, which is the U.S. stock market. Right, so if we look at some of the actual holdings in here, it's the SP 500, right? We got a lot of big tech in here. Berkshire Hathaway is there as well. So about half of it is already in the SP 500. So it's pretty heavily weighted towards US stocks. And then it has about a quarter in the EAFE, EAFE, which this is specifically looking at companies from countries that are developed countries outside of North America. So you can think of Europe and Scandinavia. Japan would be included in here as well. And we can see some of the larger companies that are in here. We've got Nestle, ASML, Louis Vuitton, this company, which I believe is a pharmaceutical company. And then going back to it, there is the TSX, so about a quarter of it is in the TSX, which actually makes it not quite a globally diversified ETF. It's a bit different than that, just because if you were to invest in an ETF that is invested in all companies just at market cap weights, you wouldn't have 25% of your portfolio in Canadian stocks. It'd be a lot less than that because Canadian stocks aren't a quarter of the global market cap. So it is more heavily weighted towards the TSX, which means it's got a bit more weighting in financials and resource companies, which is something I'm okay with. That's something that makes sense to me. And then there's also a small share is in this emerging market ETF, about 5% there, which is companies like China, Brazil, India would be in here as well. So that's kind of the makeup of this. And clearly there is, lots of international diversification, and that's kind of why I own this, right? XEQT, and this is probably going to be the main ETF that I continue to buy going forward. Now, the other large category here would be GICs slash high interest funds. So when it comes to this, I know a famous ETF that a lot of Canadians like is cash.to, which is basically just a high interest savings account, except it's a lot more flexible because it trades like an ETF. So I don't own that one specifically, but I own something similar. And then I also own GICs. Now, the reason that I have a pretty sizable portion, about a third of my portfolio, allocated into these lower risk fixed income investments is because my plan is to buy a house in the next 5 or so years. And, we'll see how that pans out, right? Because that's not a certainty with Canada's housing market. But because of that, and because of this shorter time frame, the main focus that I have for this money is preservation of capital, right? I'm not trying to grow it aggressively and put it into high risk companies that may or may not work out. My key goal with this is just to earn a little bit of a return, but really just maintain the capital so I can eventually make a down payment on a property, right? So we'll see what ends up happening there. That is the plan for myself. And the reason I've kept this out of the market is because historically it's not uncommon for there to be 5 year stretches in the stock market, US stock market, Canadian stock market, where there is negative returns, right? It's really not that uncommon. Even a decade of negative returns is something that's happened before. And again, everyone has their thoughts on where the market's going, but I don't know for sure what's going to happen. So because of that, I'm just going to keep it in GICs and make sure that nothing's going to happen to my money since they are, deposit insured. And then I included the amount I have in cash here, which is 23% of my portfolio, which you can argue that's probably too high. And I'd probably agree that's a bit high. I probably don't need that much cash lying around. And one of the things I'm reserving it for is when the first home savings account is available and I can make some contributions to that over the years and ideally get a tax deduction when I can contribute to that. Um, but I think, I should probably have more of this allocated to GICs in the interim and just short-term money market funds just so I can earn a bit of a return on that. And then just for fun, I've included this little portion here, which is collectibles. So collectibles is kind of its own area that operates by its own rules that I find very fascinating. And normally, when you talk about collectibles, from a value investing standpoint, most value investors will hear that and they'll just throw up, right? How can you talk about collectibles, an asset that doesn't produce any cash flow, doesn't have any economic value? All you're doing is speculating. You're not actually investing in anything. And by the way, with collectibles, I can mean anything from high-end pieces of art to pop culture collectibles like comic books, rare coins, that kind of thing. These things do operate in a way like the stock market because these things, they go up for auction and they get traded and things like that. And this isn't exactly something that I'm invested in because I'm trying to, just maximize my returns. It's more just something that I'm just fascinated by, just how these markets work and what causes, something to become super popular and things like that. And what's very interesting about them is they kind of work in the opposite way that the stock market does. Now, what I mean by that is in the stock market, the stock market is very predictable in the long term, but very unpredictable in the short term, right? You can take a given ETF or a given company and then say long term, so 5, 10 years out. You can analyze the company or the ETF, and then you can come to some conclusion which says, I think that it will be, higher in the future, lower in the future based on, these things which I have analyzed. But in the short term, that's basically impossible to do, right? Because in the short term, prices just fluctuate up and down just depending on, whatever the supply and demand characteristics are for those few days or few months or few weeks, things like that. But with collectibles markets, it's the opposite. So they are very predictable in the short term, but they're impossible to predict in the long term. And to give you an example, and this may seem a little weird to you guys if you aren't in this world, but if some of you guys have participated in, a certain collecting hobby, you'll know what I mean. Say there is some rare comic book, right? And it's the first edition of Deadpool, for example. If you follow, Marvel, the Marvel universe and everything, you're gonna know if there's a Deadpool movie coming out, then that comic book is going to increase in value once that movie comes out. So it's very predictable in the short term because you can look at observable things that are happening and just say, okay, well, there's that movie coming out. It's going to generate a lot of interest in Deadpool, which means this comic book is going to go up in value. But if you look at it long term, like 5, 10 years out, no one knows, no one's going to know how much people care about Deadpool anymore. So it's pretty much impossible to predict long term, but you can predict with pretty good accuracy in the short term. So that's a bit of a tangent I went on. I just wanted to touch on that a little bit, just because I do find it very interesting, how these collectible markets work and stuff like that. So that pretty much does it for the composition of this portfolio here. Now, another few things I want to mention are some emissions. Now, one of the notable emissions here is crypto. So I don't own any crypto right now. Now, that doesn't mean I'm anti-crypto. I know a lot of value investors and, the more old school investors are very, very anti-crypto. They don't want anything to do with it. I'm not really anti-crypto. I did make a few videos on crypto kind of in the very, very early days of my channel, like back in like early 2021 where I was, bashing crypto a little bit. But to be honest, I don't think all crypto is bad. I think certain cryptocurrencies, specifically Bitcoin and Ethereum, they actually do have real world utility. But I think 99% of crypto that gets created is really just, people trying to scam and people trying to, make a quick buck by, flipping coins onto unsuspecting people. So the crypto, I still think it's kind of a toxic area of the market overall. It's not really something I'm that interested in, but I do see some actual value there. I'm not totally opposed to it. And then also no Brookfield. So Brookfield used to be a large individual stock position of mine, but I've sold pretty much all my position at this point. And the reason I did that was really just because I thought that it was fairly valued, right? I initially bought Brookfield. Um, I think in like March of 2020, and then I sold it not too long ago. Really just thinking that, you know, I thought it was fairly valued for what it is, right? I looked at the business, I looked at what my expectations for the future were of the business, and just thought that, you know, it's fairly valued. And when a company is, you think that it's fairly valued, that's comes the time when you sell it. So that's what I did. But yeah, that's pretty much it for my portfolio. Again, I hope you guys weren't disappointed. Maybe you were a little bit. Nothing crazy going on here. And to be honest, I'm probably going to keep my portfolio this way forever, right? Just having 10 to 20% invested in individual companies, and then the vast majority is going to go in broadly diversified ETFs. Um, and I may make some changes along the way. One thing I want to get into eventually is options. Not like high risk, naked trading option strategies, more low risk options like covered calls, cash secured puts, that kind of thing, just to generate income on cash that I have sitting on the sidelines or generate income on an individual position I have. I think learning options, again, if you want to get into more an active way of managing your portfolio, is a good thing to look at because, there's a lot of potential there, right? Even options in themselves are a pretty brand new concept, right? Like options are something like only 80 years old, really. So I think you learning about that and getting into that world can be pretty interesting if you are the type of person that likes to, take managing your portfolio more serious, which if you're watching this, I'd assume that you are that. But anyways, guys, that pretty much does it for this video. So drop a comment, let me know what you think of this, and I hope you did enjoy this one, and I'll see you guys in the next video.